Hello and good afternoon. I'm Robyn Hall, Publishing Director of Mortgage Introducer, and welcome to our live webinar in association with SimplyBiz Mortgages. It's now been just over 2 weeks since the lifting of COVID-19 restrictions in England and our so-called Freedom Day. So what does the rest of 2021 and beyond look like for mortgage brokers? To talk about this and more, I'm joined this afternoon by Martin Reynolds, Chief Executive of SimplyBiz Mortgages, and Adam Tyler, Executive Chairman of FIBA. Gentlemen, good afternoon to you both.
Afternoon, Robyn.
Now, as always, this is a live broadcast and we'll be taking some live questions. If you do submit a question that is not answered live today, we will endeavour to have it answered privately for you. But to kick us off, Martin, Freedom Day seems to have passed with no real issues that we can see at the moment. Do you think in England it's now a case of business back to normal?
Good afternoon, everyone. Hope you're enjoying yourself and the sunshine. Slowly, I think, is the best expression. I think we're at a turning point. I think people are slowly going back to the offices now. It's not full, it's not full, and I'm sure we'll talk about it later. As will it ever be full again? How are that there? Still a lot of lenders are not allowing BDMs out into the market yet. We're seeing that, but then from the other end, we are seeing BDMs at other lenders out and about, and myself actually stood on a stage and was at a conference talking to real live people in front of me last week, which again is probably the first time in 18 months that, and more than 18 months that I've been able to do that. So I think it's slowly coming back into that sort of area of what we can feel is normality. I don't think we should compare it to what was normality, February last year. I think from a mortgage market, again, I think we are heading towards a normality. I think we had the shutdown of mortgages and it was just PTs and a few remortgages. We've had the great purchase boom. Now we're coming back into probably what is going to be normality for purchase and remortgage moving forward. So it's that, to me, as I say, it's that turning point.
Adam, are you sensing a sort of more of a return to normal now?
No, I think we're in a transition period. I really do. I mean, I wasn't in England. I was in Scotland on Freedom Day and arrived back in England on the Thursday. Complete shock to me to go in somewhere and half the people wearing masks. So for me, it was a real big shock. I wasn't there I was only in Scotland, I know, but I wasn't there for that whole sort of change on that day. So I think we're very much in a transition period. And Martin's experience of standing on a stage in front of people last Thursday. I was in London last Thursday. The normal business train I get that arrives in Paddington at 9 o'clock was empty still. That was on a Thursday. Coming back at 5:30, used to have to run to get a seat. Now there was 8 people in the whole carriage. So for me, that's telling me that we're nowhere near back to normal at the moment. I think we are very much in a transition period, which brings its own issues. If you'd sent me an email, Robyn, you'd expect me to answer it within an hour. But if I'm back out and about again, I'm struggling to answer those emails within an hour or even within 5 minutes. And the questions arise, well, where are you, Adam? I would expect you to respond to me straight away. So I think we are going to have to learn how to cope with external appointments as well as Zoom calls. But I do think we're very much in the early stage of a transition period.
I think I'll take your point there as well, Adam. It is that bit of, as some people, ourselves included, and BDM start going out on the road, but other people aren't. It is that expectation of what turnaround times, what immediacy that people will be expecting, because, as I say, some people won't be out, so we'll expect that. But if you're out doing appointments all day as a BDM, then you're not going to be able to do that. And I think that's both from their customer point of view, whether it's a lender to the broker or the broker to their end customer, but also the internal aspect of it is BDMs out on the road and talking to their underwriters. I was chatting to one last week that, they're still trying to use Zoom rather than calling them retro style on their mobile. And it's just everybody readjusting, I think, to that phase as we move through.
Yeah, I agree with you. I think the field-based staff are the ones that are going to move quicker, obviously, than everybody else. But again, as you've already alluded to, the customer is also important because the customer's been expecting a very quick response. But at the same time, you as a broker, our audience that are listening to us today, they're out on the road as well. So I think we are very much in this transition period, definitely, Robyn.
The market, you say that the market does appear to have coped remarkably well, propped up with a lot of government intervention. And with still another stamp duty deadline to pass, do you think some of this was maybe a step too far in terms of what the government's done to prop up the market? Was it entirely needed?
We were working in a market that we didn't know what was going to happen tomorrow, did we? You know, and I think some of us, well, I think all of us were around in 2008 where lots of things were happening quickly. But I think this one was different in that, yes, stimulus was needed, but then to be fair, the government does like to stimulate the housing market full stop, doesn't it? It is definitely a vote winner and is perceived from that. I think it was just interesting when it initially happened. I think the challenge was we've seen politicians now tend to float things in advance just to see what the mood of the market is. And I think by floating out, we might do stamp duty in October, in June, July, you couldn't do that. You had to then do it straight away when people said yes, because it would have just stopped the housing market. So I think that was maybe one that potentially they did want to bring in October to see if the market needed it then, but they actually, by floating it out there, they had to do it straight away. But I think it's not just that stimulus. It's been all those stimuluses around furlough schemes, hasn't it? Government, loans for self-employed. All of those bits together, I think, have created a bit of stability that have made people more confident to actually do things. So I think there's a bit of that. And then I think there's the other bit of people, I sat there when we started coming out of it going, will anybody want to move house? Will anybody want to move job because they're concerned? Yeah, it seems to have gone the opposite way. The movement in our industry of people moving jobs is phenomenal. And I think the same with houses. I think people have gone, yeah, do you know what? I've been sat inside for 12 months. That might happen again. I'm not going to keep putting my life on hold. I'm going to take those changes, those challenges, even if they're slight risks. I'm just going to do it because I don't know what's going to happen in the next 12 months. So I'd rather do it and regret than not do it and wonder. And I think that's where we seem to be as people at the moment as well.
Adam, I think as Martin said, it wasn't just residential intervention through the stamp duty deadline. There has been a raft of commercial loans available to small businesses. How do you think that's really helped the market?
Well, it's helped the small business community. And when I say small business, I'm referring to also those that are borrowing as property developers, property investors, because bridging and development finance was also included in some of those schemes. And I'll run some figures past you in a moment, for everybody who's not aware of the amount of government-backed loans that was actually provided to the SME community, which is quite shocking. But I think it has been an important part of what the government stimulus has been, that's intertwined with stamp duty and everything else. All these things have worked together. But now we face the reality of this is going to be repaid back. We've got to get that money back into the system that the government has obviously backed. However, it hasn't come out of government coffers, it's come out of our lender community coffers. They're the ones who've actually allowed that money to go, or put that money out into the small business market. They're the ones who've got to do the billing and collection. They're the ones who've got to bring it back. So bring it back in. So that itself is going to have some effect on the admin capabilities of those particular lenders. But let me give you some figures. Under the bounce back loan schemes, this was actually the smaller one. This was the one up to £50,000. These are the numbers that have gone out. £47 billion has actually gone out under that scheme to over 1.5 million borrowers. Under the larger scheme, which was CBILS, which was 50,000 up to 5 million, 26 billion has gone out to 110,000 borrowers. And in total, when you add up all the other schemes, there's been a total of over 80 billion pounds worth of guaranteed back loans gone out into the business community. And included in that are bridging loans and development loans for ground up developments, for refurb loans. So they've actually been included. This isn't just cash flow loans to normal trading businesses. This is property loans also included in that overall amount. And now when that scheme finished, it was replaced by the recovery loan scheme, which is another government-backed scheme which runs through to the end of the year. So we're still adding on top of that 80 billion pounds. So there's a lot of money that's the lenders are putting out that are backed by the government, which is great. But one of the positive sides of it is we are seeing a lot of return to normality. There was a lot of lenders, particularly in the specialist property finance part of the industry, that didn't take part anyway. So we are seeing some return to normality, definitely in the lending market. particularly around commercial property and around obviously bridging loans and development loans. However, I just wanted to highlight that it's not only stamp duty, there were another raft of loans backed by the government that have also gone out as well.
Well, 80 billion is a shocking figure, really, isn't it? And it does obviously have to be paid back. Can you see any problems further down the line with this?
Yeah, no doubt. I mean, anecdotally, I haven't got the evidence to provide, to anybody, but anecdotally, certainly the bounce back loans that were taken, weren't necessarily always used for the purposes that they were lent for. And the same with people taking CBILS loans. If you're going to be allowed to borrow money at a very low interest rate and not pay interest for the first 12 months, as a business, you're going to take it and you're going to hold it on your bank account just in case you need it. So there's a lot of money that went out like that. And how that's all going to be repaid, we're going to find out over the next 10 years. But if you think of a major lender that's played a big part in that money going out, they've got to have staff who've actually got to collect that money and get it back in. They've got to look after it once it gets to the interest starts being repaid after the first 12 months. They've got to get it back in at some point. How much of that capability is going to be used in doing that doesn't allow them to lend money to new businesses or for new projects? So you have a whole different conversation, Robyn, which we could spend the whole 40 minutes talking about how other lenders come into play, specialist lenders, new banks, how do they fit into that equation where they're not encumbered by those particular loans?
Okay, well, we might come back to that. We'll see. Just move on now. Latest research from Savills shows that after a strong start to the year and over 200,000 transactions in June alone, transaction volumes are projected to total 1.62 million this year, more than a third, 35% higher than the yearly average over the 5 years pre-pandemic. It's an awful lot of transactions. Do you think the purchase market has peaked? Martin?
I think it's definitely peaked, as in, if you look at it, you're not going to get that sort of level again because of the stimulus that was there. I think that's hopefully a once in a lifetime stimulus and we don't need it again. I think going back to where is the peak, I think that the average for new house purchase has been bobbling around the 750,000 for the last few years. Historically, before that, it was around the million. So we were in a decline anyway. So I think we've got to probably be sensible, and that's probably incumbent on yourselves as well, Robyn, even as publishers. Is we know that what's the headline going to be? We're going to see it definitely in the nationals. House purchase market drops off a cliff in July because they're only going to look at June. As you say, there was 200,000. I think to me, it's let's start looking what happened in July. What happened in July 2019? That to me is the right barometer. Is it July is traditionally quiet anyway because people go on holiday. So July and August are quieter for purchase, then picks up in September traditionally. So I think we just need to be mindful of looking at the data and making sure that we're using the right comparisons to make sure that that's there. But I think we are at a natural area. I think there are a few challenges as we move into the next few years. I think stock is going to be an issue. And I think we've all worried about that this year as well, that there has been a slight slowdown of second-hand properties going on the market. Again, though, is that just natural because it's the time of year? Let's see what happens in the autumn. I think the new build market will have some challenges. I think there are some big issues around actually getting materials. So it's not necessarily much the labour to build the houses, it's actually getting the materials. There's been a mini boom in home improvements as well. You can't walk down a street without seeing skips outside. People are doing that. Those materials are needed. The prices have gone up 50, 60, 70% this year on raw materials because they're just so scarce. So it's how quickly that production can get going to get the materials back, and then who gets them. So, will the home improvements carry on? So therefore they'll want it. Will the new builders need it? And then in the background, the rumour is you've got HS2 that are buying up lots of material because they need it to build HS2. And if you look around by me where it's coming, fairly close-ish, they haven't even started building it. They're still knocking things down. So the actual use for that material is going to be quite high for the next 4 or 5 years. So I think that is going to be a challenge in the new build market. So again, will that mean that slows down the availability and new houses on the market? So, I'm sure we might touch it later on. It's where do we get that new stock from? That could be the challenge.
Adam, is that creating a sort of a demand in the development finance market as well?
I mean, let me sort of go back a little bit. I mean, I'll talk about that as well, Robyn, of course. But I mean, the commercial market has always lags behind the residential market. I mean, during the financial crisis, we were 1 or 2 quarters behind. You know, we saw the residential market stop suddenly in 2007-8. Of course, we still carried on for a couple of months afterwards, and I think that's the same now. But the commercial market's also dictated, as a lot of things that happen here, by the US. And we're starting to see a slowdown in the US commercial market, albeit where you'd expect it to be in retail and areas like that. But that's something that will also come across to us. So at the moment, I can't give you reports and say, yes, we've seen a tremendous slowdown in the number of inquiries, because I'm not getting that. I'm not getting that. But inevitably, we will follow exactly what's happened within the residential market. It's, you know, sure as night follows day. That's just what happens to us. So we will lag behind as always. But I mean, the development piece, which Martin's just alluded to. I mean, I saw a report today, there's a timber shortage. You know, alongside that, there was a shortage for whatever commodity is in the supermarket. There's now a timber shortage, and timber prices are up by 50 or 60% because we can't get hold of it. So there are a number of factors that are definitely going to play a part in it. However, the market that we operate in specialist property finance, particularly in the bridging space, in 2005, that market was worth about 300 million. That market's now 7 to 8 billion. So we've seen huge growth over the last 15, 16 years, and particularly even in the last 10 years or so. So we're at a very, very high peak anyway. So I'm not saying we've got a long way to fall, but we've built a market, and I'll talk about that later on, how that market's been built on the back of the lender and the broker community. So we've got a very, very sustainable market now that, yes, we will see some potential slowdowns, but I think that we are big enough and lucky enough to be able to get through that now. However, there's lots of other factors that are going to play a part in it. And never before has the residential market and the commercial market ever been so entwined as it is at the moment. Very, very much so.
And I think, Robyn, if you go back, I know that was the purchase market and transactions there, but as with always, there's different factors that are happening within the market. So yes, maybe the house purchase market might, well, it will slow down, but hopefully stay at the normal levels, which keeps everybody busy. But then you've got the remortgage market starts coming into play for the second half of this year and next year. So, you know, you've got 2 big months in September and October this year. You've got this 5 years in October from the changes in the buy-to-let market, when everybody was taking those 5 years fixes before the criteria and the stress testing changes came in. So they're all coming up for maturity now. So there's lots of work there. There's lots of customers and clients that need talking to. And then next year is probably the biggest cessation year in probably the last 5-10 years. So, you know, there's plenty out there that we shouldn't just keep focusing on the purchase market, because that remortgage transfer market is going to be very buoyant next year and the end of this year.
Yeah. And what's happened as well, Robyn, is that the property investors for the time being have stepped out slightly from the market to see what happens. Obviously, as of the 30th of June, just stepped out slightly, and the rumour is that come September, October, the property investors will step back in again, which is obviously going to rejuvenate not only the commercial refurb market, but also the buy-to-let space as well. So I think we are in this, as Martin's already said, a quiet period in July and August. That's just what always happens. But September, there's a number of factors that could play to our advantage, but also, you know, when you talk about the lack of materials and things like that, that could play to our disadvantage. So it is still quite an unknown quantity, but I'm personally very, very confident on both sides of the fence.
Just a reminder to those watching from home or in work, we are taking live questions, so feel free to get in touch. Don't be shy. And some of this we will come back to later as well. So Adam, slowdown in the US commercial market is happening, and it will happen over here. Now, if I was a broker watching this, I'm thinking, do I really want to get involved in a market which is slowing down? So is it too late for brokers not already in the commercial space to get involved?
Oh, far from it, far from it. I think, you know, I better sort of just caveat that a little bit to say again, to reiterate that the slowdown is expected in the spaces you'd expect it to be in things like, retail, shopping malls, things like that, you'd expect to see a slowdown there. But in terms of what we're seeing in the UK and in the US, I mean, if you went and built few great big sheds in a field somewhere, then you're going to have plenty of customers because we're all buying stuff online and continue to buy stuff online. That's going to be stored somewhere. And that's just, the two sides of the coin, one retail and one sort of warehousing. Offices obviously are the ones that are going to cause us the greatest opportunity or the greatest issue over the next 4 to 5 years. We just don't know. But let me give you some numbers again, because that does bring things to life. I mean, we now have 5.4 million small businesses in the UK, highest number we've ever had. Some of them obviously will, work from their dining room table or from the back room. Those businesses will grow. They will inevitably grow, so they will need somewhere to operate from. So that's always going to create a demand. And we're going to see more and more people in the small business space anyway. That's always going to happen. Now, in 2020, FIBA doubled its membership. We doubled our membership doubled because more and more people wanted to get involved in specialist property finance. In 2021, it's grown by another 25% on top of that again. So you can see that there's more and more people wanting to be involved in this particular area. But at the same time, we've seen the lenders grow. I mean, Robyn and I, we've known each other for many, many, many years, and we've seen many lenders come into the market. We've seen lenders go as well, haven't we? But those number of lenders involved in bridging finance, development finance, commercial mortgage, specialist buy-to-let has always grown, and it's grown because the market's grown. I've already demonstrated how much bigger that's got. And you add in things like more regulation, professionalism. You're seeing more and more people become involved. And then you add in the repurposing of some of our buildings we've got in town and city centres that can no longer be used for retail. They're not necessarily going to be used for offices. Those buildings may jump now straight from retail to residential. And we come back to the point that Martin raised about housing stock and there being a housing shortage and building materials. Well, if you've already got a building that's laying empty for a couple of years and nobody wants to take it as a shop, why not take that shell and turn it into some accommodation that can be used that can fulfill that housing shortage? So for me, brokers, it's always been important that every town, village and city has a broker that can deal in specialist property finance. That's always something I've advocated, because then you have the networking capability of the local developers, the solicitors, the accountants to say, there's a guy in the town there who knows how to raise finance on that building to turn it from retail into residential.
I think there's also the bit that,
no, it's not too late.
I think there's also the bit that actually the product is moving across from one to the other as well. So, look at buy-to-let, that now goes straight from, the single investor who's buying a couple of buy-to-lets through into limited company, which is now becoming quite mainstream in our world, but actually started off in the commercial world. So you're already moving over to that. Then you've got the bridge to let sort of product set. And then you've got, as Adam's just saying, that development to change a property from, say, an office or a shop into either a house or some flats, which then becomes a rental property. So, that whole landlord journey sits across both sides. So I think for an advisor to look at that market, it just means you can actually have that customer, that landlord all the way through that journey and offer them all those various types of buy-to-let property. And that's just one product in itself. But there's more and more of those products that I think are starting to seep across into what I'd call the traditional residential buy-to-let broker market.
And the lenders, Martin, have become very innovative. They've come up with these solutions now, haven't they? I mean, whether it's bridge to let or development exit products, there's all sorts of different products now to cater for those needs. And, when we set up Specialist Property Finance Club, I like to list the different types of bridging loans. There's not just one bridging loan anymore. There's 13, 14, 18 different types of bridging loan to suit those different circumstances that arise. And you throw in regulation into this conversation as well. And of course, if you've got a fully regulated broker that's operating in residential space, he's always quite welcomed by the specialist lenders because he's doing things in a way that they can adapt to and like very much.
Do either of you think we'll see some consolidation in the specialist lending sector? Certainly, if you look at the likes of, say, buy-to-let, the number of players in that market, certainly from a non-bank lending point of view, there is surely some opportunities. We've already seen Starling Bank take over, acquire Fleet Mortgages late last month. You see Any other movements like that happening in the not too distant future?
We've seen a bit, so I'm not sure whether it's consolidation, because obviously you've had Fleet and you've had Foundation. They're being bought by people who aren't already in the market, so they're just somebody who wants to get in. I suppose the only pseudo consolidation you had was One Savings Bank and Precise, which is what, 2.5 years ago now, or no, sorry, nearly 2 years ago. And then obviously we had TML and Shawbrook last year as well. So there may well be a bit more, but I think what you'll find is that there'll be more smaller lenders in that market, catering in those niche areas, and maybe more coming out. And we've seen, people like Lend Invest have gone onto the stock market. They sit both sides, so they've got that product set that sits both sides. I think you'll just see more lenders that will sit with one leg in each camp, in the buy-to-let camp, and the how does it get to become a buy-to-let product camp as well.
Yeah, definitely. But also, I think that we'll also see the smaller lenders that have grown up, that the ones that are very well funded will continue to thrive in the way that they are, because we need lenders, particularly in the specialist market, to be fleet of foot. We need them to be able to get to a decision maker very quickly. And that's how our market has become the size it is because we've had that ability to be able to adapt and actually say, yeah, we can do a deal there, because if we shape it like this is how it will work for you as a broker and for you, Mr. Customer. We can't lose that. We can't put everything down into larger lenders. But in answer to consolidation, yes, you're going to get lenders that are going to get to a point where the originating team are of a size that they need to combine it with somebody who's got much more support behind that. So I think you will see it, but at the same time, I think we need to make sure we preserve the smaller lender and keep that smaller lender in the market.
On the flip side of that, then, do you still think there's opportunities for new smaller lenders to enter the market?
I see them every day.
You don't think there's...
Yeah, I see them all every day of the week. I'll not every day of the week, but certainly a couple of times a week, I'll talk to somebody who's thinking about becoming a lender in this market. Not all of them get through to it, because get through to that point by any stretch of the imagination. The key to all of this now is to have the right funding behind them. As COVID has proved to us, that we need to ensure that the sustainability and the continuation of funds for our lender community is all important. And that's key. So one of the first questions that we ever ask anybody is, where's your funding coming from? And I think now, yes, the whole market in the beginning started with high net worth individuals putting money into the bridging market, and we obviously got warehouse lines and funding from all over the place. There's plenty of money available for the market, but it's sustainable is the key to it, definitely. So there is still a market for them. Sorry, Martin.
Sorry, yeah, it's then having the proposition as well. You can't have a plethora of them coming in at, with Me Too lending. They've got to do something different, because all you end up is pushing price down, which is great for the broker and great for the customer, but then that sort of turns the investors off then as well, because they're not making the margins that they thought they will, so they're more likely to pull out. So I think it's coming in with something different, or a different way of doing it that's going to help move that and make more people want to come in. Or you'll just see, as we've seen, people will just buy into existing businesses and give them wider funding lines. We saw that with Lambay. I was with them today, and they said, they went into lockdown with 2 funders and they came out with 4. So, people will go in that way because it's straight in, and they can just get straight to market quicker.
And the cost of funds is important as well. So the cost of funds that you're buying the money in out to lend out to customers is all important now. The market's become very competitive, and if your bridging loan rates are sub 0.5% per month now, then you've got to make sure your cost of funds can reflect that. There's a space for more complicated deals that are more expensive, and quite rightly so, because there's more of a risk to the lender. But pricing is also important, and this is something that we've seen happen again over that 10-15 year period. So the market has evolved, it's matured. It's not as easy to enter as it was unless you're coming in, as Martin said, into a very niche space. You can't just come in and say, I'm going to do bridging loans and I'm going to charge this amount. It's just, you've got so much competition to do that.
Let's take a question that's just coming from one of our viewers, Matt Maudsley. He wants to know, how do you think technology and automation features in the medium term, especially against the backdrop of needing a human touch for complex and non-vanilla cases? Adam, do you want to take that one first?
I'll take it first, because again, it's something that technology for us, sourcing tools was something we can never put into place into commercial finance. It was always, when I was involved in broking in the mid 90s and we were using Mortgage Brain, that was the technology then, because that was something we could do. You can never apply it to commercial finance. And it's more difficult to do it today, but you can do it. However, technology is playing more and more of a part in specialist property finance in lots and lots of ways, not only in sourcing, but obviously in data collection, ID, for example, obviously be able to ID people remotely. That's something that we use as well in the commercial space. Obviously, AVMs, all sorts of different things have come into the commercial space that have fallen over from the other side in the residential arena. And we're actually at the moment finding a number of different platforms to help brokers and their customers get the solution much, much quicker using technology. So technology is advancing. You wrap that up into the need for for more regulation that's coming in, proving audit trails, proving which lenders you've been talking to on behalf of the customers. So yes, technology has got to play more and more of a part. And as I said, at the moment, we're trialing and using any number of different technological solutions for us at FIBA and for our members.
And I think on the residential and buy-to-let space, it's been quite interesting to watch the last 18 months because pre-lockdown, the holy grail was how many integrations can we get between systems into lenders' systems, frictionless, straight through processing, no rekeying for the broker. But with what happened last year and, depending on who you speak to, 25 to 35,000 criteria changes last year in the residential and buy-to-let space. That sort of need for technology moved earlier in the process. It was very much about the criteria tools, the affordability sourcing tools, the ID, because again, people weren't seeing one another face to face. That became the key part of the process that everybody was really interested in, and a lot of work won. And sort of that integration with lenders got put on a sort of back step. It's coming back in, and we're seeing that. But I think what's been really, really good to see is that technology has grown. I think, we've all, we're doing this now. We wouldn't have been doing this 18 months ago, Teams meetings, so they're all happening. So I think, but to me, I don't think technology can replace the advisor because of all those complexities. We've seen lots of robo advice, we've seen it in other areas, in other parts of the, in investments and that, and they haven't quite taken off. I think it's a harder challenge in the mortgage space because in investment space, you've got one customer, lots of questions, there's your risk rating. Here's some investments in that risk rating. In a mortgage, you've got normally two customers and a property. All of those things have got variances. Yes, you can do certain things and you can funnel bits down. But to me, and what we work on and what we're working to is how can you use technology to wrap it around the advice process to actually give the advisor more time to actually give that advice. To me, that's the key bit for me is how can we utilize technology? How can we get the customer data into the advisor quicker? How can we get it out to all the various bits that they need to do in that journey to make it better? Because the journey is still very disjointed, and that's before you get to the lender, before you get to the conveyance, before you can get to the valuations, all those bits, and we're all working to them. And the interesting bit is even if we'd have got all of that done over the last 18 months, in June, the biggest problem was you couldn't find a white van to actually move. So even if we'd have made everything seamless, you still needed a human person at the end of it to help you move. So I think it is making sure that as an advisor, we show that value of what we do. And it is that bit about all those changes in criteria. What do you need to do? Do you know where to go? How do we develop all those processes? And that softer skills bit. But let's give the advisor more time to do that rather than number crunching, keying, or wandering off looking for reports.
Yeah, and that's exactly the same with us, Robyn. That's exactly the same issue we face in the specialist property finance space, is all those same things, is actually understanding the number of lenders that are out there and what those lenders do. And if there's 130 lenders in the market for us, that's a lot more than there was in the past. So you've got 130 lenders to consider, and you've got to make sure you pick the right lender, and you've actually got the trail to show why you've picked that particular lender. So all those things that Martin's just alluded to are exactly the same as specialist property finance. We need to do those same things. So that's where technology is helping us. It doesn't replace good old-fashioned knowledge and knowing exactly what lender A does over lender B and having those connections and that personality and knowing the individuals there and what the underwriter's looking for. You'll never ever replace that. You still need that human intervention, but you still need to use technology perhaps to see the wider range of lenders that are out there.
Adam, do you think the role of lender BDM will have changed forever due to COVID? Just in terms of, there's a lot of meetings being done over Zoom, not on the road, maybe 5 days a week anymore or 4 days a week.
No,
how do you think that's going to impact?
For me, in my world, no, I don't. I think, the good old BDM is still needed for a variety of reasons. And one of those is because the broker needs to understand, as I've just alluded to, exactly what that lender's looking to do. And whilst you can tell them what they do over a Zoom call or a Teams call, nothing beats that BDM calling into a broker, whether they're working from home or from their office, and over a cup of coffee explaining what they're looking for. Because that, I can guarantee that broker will have a deal on the desk, will have a deal on the desk the next week that they would like to put to that BDM because that BDM's been in to see them. And that's something that I still advocate, that if you're a BDM and you're out and about, see your brokers, talk to your brokers. And I don't think we will, and I don't want to see that lost. I don't want to see it replaced by this. I want to see the brokers dropping in, the BDMs dropping in on the brokers and having that conversation with them.
Martin, but do you think that the role of the BDM is going to change, or has already changed? Will it stay the same?
I think it's already changed. I think it's definitely already changed. I think you'll see, again, I think it depends on which part of the market you're in. I think while everybody's been at home, I think doing lots of calls and Zoom, so using both, getting to talk to a lot more people. I think depending on, if you're a high street bank, will you be doing as much face-to-face? Maybe not, because it's slightly different. That's more account management and relationship, because most brokers will probably know those big high street lenders inside out. So it'll be more about that relationship. So that could be picked up by a lot more short, sharper meetings, whether that's Zoom or telephone calls, with maybe, every 4 months of face-to-face or every 5 months of face-to-face. So that will be different. I think the bit that could go back to as close as before is that specialist market. Because I think that's where you have to, as Adam alluded, you have to sell the proposition, because you're normally using those sort of lenders because it's that manual underwriting. It's that bit about needing to talk about a deal, to understand that deal. And I think that's where I think a lot of BDMs, you'll see them out. And I think, you've seen for the last month on LinkedIn, most of the BDMs that have been putting things up about, we're out and about, we're having meetings, from that specialist, maybe smaller building society community that are out there talking deals rather than natural account management. So I think you'll see a wider shift in that as that happens, as that moves forward.
Well, talking about wider shifts, Donna Murray from Green Shoots Financial, she wants to know, will firms move back into their offices full time? What does the new flexible working balance look like? I know the FCA told off at least one lender for getting their staff in fairly early, when the FCA themselves don't have their staff in the office. Martin, how do you see this sort of work office relationship going in the future?
There is not going to be a right or wrong answer. It will be, I think it's back to this point of listening to the voice of your customer, whoever that customer is. So, if you're a broker, will you come back because your customers want to see you face to face, or have they got used to doing it like this now? So actually, do you need to be in the office for the customer aspect of it to do the business? Who knows? Then there's the bit as, depending on the size of your business, do you want people in the office so that you can have the team meetings? Do you feel that you get there? Because I think there is a couple of bits about being in the office as a broker is that team meetings. How do you get everybody together? It's hard to do that. There's those conversations that happens up the corner of the room in the meetings that you can't have on Zoom or Teams because everybody's listening. So you miss those. And I think that bit of swapping of information of what's happening in the market as a broker. I've got a case like this. Who will do it? Does anybody had one? And if you're in the office, people go, yeah, I had one of those a month ago, try X or Y. I think those bits are missing in that office, but I think it will depend on that. But I think what you're seeing though is more and more people are starting to employ people that are a long way from their office now. So I think we've got through the last 6-8 months going, actually, I was struggling to get advisors in my area, but actually, do I need them in the office 3 days a week? Can I put up with them being in one day a month or something, or one day a fortnight? And they're actually looking further afield for good quality advisors. So I think, again, it'll depend on the size of your business as to how that works. So there is no one answer. I don't think, lenders will accept that they'll start working. We're looking at, there will be that flexible working. It's just making sure that people can still be as productive by being at home as being in the office. And importantly, that you can manage and measure it. And that's not to check up on them, but if you're running a business, you need to be able to measure the output and how things are working. So you've got to be able to measure that if people are working from home more often, whether you're a lender or a broker or a distributor like ourselves.
Adam, you got any thoughts on that?
I have, yeah. I mean, there's a bit of a disparity. I mean, the lender community in particular seemed to go back into their offices a lot quicker than the broker community did. And in particular, if you drill down into that, the underwriting teams, I think it's important that the underwriting team, especially with the specialist finance lenders, are all together, because it's easier for them to discuss a case in very much the same way as Martin said about the brokers. Anybody know where to place this deal? You know, the underwriters could share experiences. They can look at a particular deal and say, yeah, I know that one because we did a deal like this, you know, here in the past. So I think we need that. We particularly need certain sections, but at the same time, you know, traditionally, yes, everybody went into the office for a certain number of days a week, regardless of whether it's our industry or other industries. I don't think we'll see that. I think we'll see people varying it with 1, 2, 3 or 4 days a week in the office and other days working at home. And, you know, it's just the new world. And then you know, I'll come back to what I was saying. What opportunities does that throw up for us in specialist property finance? You know, repurposing these buildings that were offices. Do they become retail or do they become residential? Do we solve the housing crisis because now more and more people are working from home? So there's lots and lots of questions to answer over the next 4 or 5 years about, you know, how we'll all work and where we'll all live and what we'll all do on a day-to-day basis.
Just got a final question for you both here on the later life lending market. So the total amount of secured and unsecured debt owed by people aged 55 and over is expected to rise from 226 billion in 2020 to 236 billion in 2021, but mainly due to more consumers purchasing big ticket items such as property and cars, both of which require loans. Do you think COVID has helped to mature the later life lending market? Martin, to start with you.
I wouldn't say mature, because I think it was already naturally maturing anyway, wasn't it? It was growing. We've all been saying it's the next big market for about the last 10 years, haven't we? Plus, and I think we've seen that steady increase over the last 2 or 3 years. I think what's been interesting is to see the purpose of the loan. So you mentioned that buying property and cars, whereas historically a lot of it was that nice big holiday, etc. But we're also seeing a lot more of that home improvements. People are deciding, back to we said earlier, people are doing houses up. That's not just people of working age, that's people of retirement age. They're saying, well, actually, we want to make sure that this is comfortable now. We're going to be spending more time in it, making it in the right way, accessible for them. And also we're starting to see, and we've seen it before, we had the bank of mum and dad. I think we're also starting to see the bank of nan and granddad as well, of people saying, actually, let's get the inheritance out now and we'll enjoy watching the kids or the grandkids enjoy that inheritance of getting on the property ladder as well. So I think it's not so much a maturity of it. I think it's just a changing of the purpose that it's being used for is differing now over the last, well, this year definitely, but it started probably a couple of years before that as well.
And just to build on that, Robyn, to give you another angle on it as well, is obviously what's happened through COVID is that under the furlough scheme and changes to people's businesses, there's obviously been a number of redundancies, and some of those redundancies have been with the older population, the population that's closer to retirement, that's going to need to fundraise. And they've fundraised obviously for various reasons, and one of them has been to launch a new small business of their own because they can't get back into employment as easy. So they've borrowed money to launch a small business, whether it's from the dining room table or whether it's from premises or anything else. And sometimes, you know, that's a way of fundraising using the equity they've got in their own property. But that's another big conversation we could have a whole session on as well. So.
Well, maybe just to close then, can you get some final thoughts from you both on how you think, very short answers. Adam, we'll start with you. How do you think brokers overall, how do you think brokers have adapted to the current conditions that they've had to live through?
I think in short answer, brilliantly, really have. You know, from the way we used to work in February 2020 to where we are today in August 2021, it's been a revelation. And if you'd said to me that that's how we'd all be operating and we'd be on these calls, because, you know, if you asked me to do a webinar 2 years ago, I said, no, I'll come and see you. And I think brokers were all of the same mind, particularly in our sector. Now I'll come and see you. Now they're more than happy to jump on a webinar. So I think they've adapted brilliantly over that period of time.
Martin, some final thoughts from you?
I think that the mortgage market has always been great at reinventing itself. You know, we've gone through the downturn of 06. We had 2012 onwards. We've had lots of regulations seemingly changing, MMR, all those things, and it's brokers just go, yeah, dust myself down, right, where's the market? Let's just go and find that market. And I think brokers are actually great at making sure that they look after their customers and then spot the new opportunities in the market and go for it. So they're very resilient and very flexible, and I think they do a great job and should always be proud of it.
Fantastic. Well, thank you both. That does bring our well, that does come to the end of this special Mortgage Introducer webinar in association with SimplyBiz Mortgages. Thank you to Martin, and thank you to Adam, and of course for you, thank you at home for watching. You can watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you and goodbye.